started with our last session of the day. Our final session in the financial inclusion track explores the development and implementation of innovative financial products tailored to the needs of the underserved population. This includes microloans, microinsurance, saving groups, and other financial instruments designed to provide financial stability and growth opportunities. What we've observed at IIC Research is that microfinance enterprises have stepped up to a large amount of funding raised in 2024, with close to 300 million raised by the sector between January to June 2024. So that's the first half of this year. With this backdrop, I'd like to introduce our distinguished panel of experts. Anirudh Sardar, Head of Equity Investments Asia at Oiko Credit, Arpita Pal Agrawal, MD and CEO at Diya Vikas Capital, Manmeet Singh Soni, Chief Business Officer, Sales and Collections at Neo Growth Credit, Pradipto Biswas, Founder at Plataforma Asia, Pooja Monga, Senior Investment Associate at Beyond Capital Ventures, and the session is moderated by Shashank Awasthi, Co-Founder at Ali Venture Capital. Over to you, Shashank. Thank you.
Good evening and thank you for being here. The doors are going to be locked so you can't escape for the next 15 minutes and you have no choice. Fortunately, we have Pradipto here, so not that I don't trust the others, but he's clearly a shining light. But thank you so much for taking the time to be here. I'm the moderator because I'm super fond of my voice. The only way to moderate is to make me the moderator, which I'll try and do not too bad a job of. What I'm going to do is this. Instead of going into detailed introductions and all of that, because I think every speaker here has something very interesting to tell us. What's happened, I think, is that we've taken this very broad brush around, innovative. If you look at each of those, very heavy duty, innovative financial products, underserved, and all of that. Right? Each of those you can speak for a day in general. I think all of them can, given the constituencies that their capital gets allocated to. What I'd like to do is, I'm just going to request maybe starting with Anirudh this way in. You just tell us, what is it that financial inclusion really means in the context of your work? Because by the end of this, you'll see the diversity of thoughts that are here. But as you can see from our titles, there's a different bunch. There's somebody who's doing to businesses, then investments that are going into microfinance and other services. Do you have any thoughts or questions? Are you here because you thought we'll get some good air conditioning and coffee? Or is there something else? Because then we can try and answer that, right, and make it focused. Otherwise, of course, there's stuff that we want to say. Does anybody have anything in particular you're hoping to hear? You have something in your mind that you think might come from this panel?
I think it would be interesting to know how consumer loan as a financial product for low income segment is looking to from each individual lens. Like we talk a lot about business, MSME loan, etc. But how is consumption loan looking?
You just close Manjeet's heart. But anybody else? So I think we're going to get a very interesting else from you and of course the MFI experience. But anybody else? Is there any other question in terms of loans for individuals other than that? No? So we get started. Should we get started? Yeah. And I think just maybe request you to tell us a little bit about what financial inclusion really means in the context of the work and the capital allocation that you do. As a starting point, and then you can quickly do a round of that with anything else.
Sure. Yeah. Hello everyone. I'm from Oiko Credit, and our organization has been there for 49 years now. We were formed with the mission of really working on social justice. And with that in mind, we decided to invest both in the form of debt and equity in the sectors of financial inclusion, agriculture, renewable energy. I and my team, we are more responsible for equity investments, and we do right from $1 million to 10 million euros. Series A, Series B, Series C. When we started, so we were amongst the pioneers of doing microfinance, and this may also address the question that you raised. So microfinance for income generation or consumption, and it's both, and I think both are important. While income generation, all of us know it's obvious, but even consumption finance is super important because we don't want people to fall into poverty traps. And microfinance provides that income smoothing support just to prevent people to fall into a poverty trap. Having said that, from 2018 we started working aggressively on tech investing. So fintech, uh, first investment was 2019, and there our thesis has been that, especially emerging markets and low-income people, a pure tech investing model we don't think is the right or the ideal way of serving them. We believe more in hybrid models. Uh, we want a human interface, especially who can work with borrowers who are less tech savvy, handle them. The beauty is it also helps in terms of better underwriting quality. So that served well with us. Second aspect which we focus more on is on livelihoods and income generation. While our microfinance companies have served the consumption angle, but we like income generation and livelihood more. So think at those places we focus our investments more. Thanks.
But that naturally logical progression given the work that we have with us an opportunity to globally. But may I also request you to build a little bit more on this livelihood pieces and how the smoothing of cash flows, right, for individuals really tends to create the opportunity for increased income. So, I mean, please go ahead with whatever else, but maybe you can shed a little bit of light.
Yeah, sure. I'm Arpita Palagarwal. I am the MD and CEO of the Vikas Capital. We are part of the Opportunity International Global Group, and we essentially have been in India for the last 15 years. Mostly the first investor in a lot of microfinance companies, so we should get in at the early stage at that point. And I think the main thesis and our main objective of our work has been work with, at that point it was very gender focused, poverty alleviation. So it's about addressing poverty and how we do it. So microfinance at that point when we started was the establishing model. Work started with that. To your question, Yashodhara, on consumption loans, whether you call them personal loans, totally agree with Anirudh that they are equally important because people we serve, they are just one crisis away from falling back into the poverty. It could be a health crisis, it could be a death in the family, it could be anything like that. Having said that, I personally also ponder a lot on have we left them better off? But when we see a woman in her 5th cycle of getting a microfinance loan, is it a constant treadmill we have put them onto? Because are they getting onto the next one? Ideally, one would think that if a woman is has been on a 5th cycle, 6th cycle of a loan, she should start accessing the the formal banks where the cost is obviously lower. But we don't see that happening. So I don't have a ready answer for that, but that's something that we ponder, and I personally ponder about that when I'm looking at my finance models. But again, our journey has also been that we are realizing that poverty is it's not just about lending money and hoping to tide them over their income income yo-yos. It's also about helping them build a house. So affordable housing is also something that we are interested in. Livelihoods creation, because that at least addresses the first point I was raising, that you leave them better off. Because when you're increasing the household income, you're bringing some more resilience in the family. And maybe the kids will remain in school. They will aspire for a higher education. Maybe somebody falls ill, then they are able to deal with it better as a family. That said, I think the other unique thing about Opportunity and Vikas is that we also handhold our partners through interventions on health and also on ag finance. So depending on who needs what, we are also focused on edu finance. In fact, we have a global tie-up with Credit and edu finance. Opportunity has one. So these are all areas which the bottom of the pyramid families and beneficiaries needs to be stop at that.
Yeah, thanks. Because I'm glad you brought up something for which I must give credit to Pooja, which is a question that I wanted to ask when we do the round the other way, which is around, what is it that others need to be doing? We are talking about what we are doing, but I think very clearly, and in the last 5 minutes, I was talking about the stuff that's broken along the way. He's taking the approach to solve that. So what else is broken? Does it really take 6 or 12 cycles to be able to finance. Maybe it's an understanding that we need to challenge, or maybe the banks are simply not drawing enough. 8-10 years ago, we said, it's the credit bureaus come in and all this will change. But here we are, still talking about the same thing. My request to you is build a little bit for MSMEs, which I think are really, I won't use the word poverty, but they're really capital starved, right? And which is why firms like yourselves are building such incredible businesses. But I want to take a slightly counter, is there a risk that there's overleverage, right? So they've gone, if somebody is too hungry, and then they have no control over what's available to them, and I'm sure you're doing a great job at underwriting. But is there a risk that you see that may be happening for firms that have operated 10, 20 years as small businesses with very, very limited access, at least to form a high quality capital like yours?
Whatever we say, MSMEs always have a very limited shelf life. Okay, not only because of the nature of the business that they are into, or the, I would say, the limited access to credit or loans that they have, but also because of the macro environment. You yourself can see after every 3 to 4 years, be it your demand or GST or again this year seems to be on the lower side. So yes, whenever they have a limited shelf life, time comes when there is a liquidity freeze in the market, so they are short of funds, and given the segment that they operate in, the traditional banks or even your large NBFC, they also face a lot of challenges lending to MSME segment, largely because of their informal business practices. Again, lack of collateral are the most common reason, and also that the inadequate financial record, because they do not have their balance sheets and P&L as strong as other upper SME or large corporates like. So I think problem always remains as just answering to coming back to what you were mentioning. But yes, at our end, if I talk about neo growth, we essentially what we do, it's a flow-based lending that we do, okay, wherein we assess this MSME segment based on the digital cash flow rather than looking at the historical data. When I say digital cash flow, it's more about the digital transactions that they're getting into their bank. That's the way we analyze. Also, nowadays what you will find, the MSME segment, if I talk about the total addressable credit segment, credit demand overall in the Indian economy, it is close to, one of the reports which I was going through was close to 70 lakh crore, out of which 25 lakh crore seems to be met by your traditional banks or your formalized segment. But again, there's a credit gap of almost 45 lakh crore. That's a huge credit gap amongst your underserved and unserved MSME segment. And therein, fintechs or your new age lenders like us pitch in to address that gap. Essentially, why do we need to address that gap? Why? The reason being because if you are able to ensure easy access of credit to MSME sector, that leads to formalization of that sector, okay, which eventually lead to inclusive growth for overall economy. I think broadly that is what. But yes, coming back to the point, risk largely wins because the more they are over leveraged, the chances of getting delinquent, and eventually when any change in the monetary policy or whenever there is a stress in the macro environment, other players stop lending. So then that cycle breaks, and then they start defaulting.
I think clearly amongst the first three, formalization story, which we've all aspired for over the last decade or so at least, isn't panning out as nicely and seamlessly for sure, right? In individuals, we aren't seeing that graduation as simplistic as we assumed it would happen. In MSMEs as well, I think there does seem to be, but we would agree that the graduation doesn't take place because the 25,000 crores that's coming from other places, people are still thinking about that this is the segment that I want to go after, and there are others who are taking care like yourself. So that graduation is not happening there as well.
I would say it is happening, particularly post-COVID. You will find a lot of new to credit customers, lot of players, especially this UPI evolving, digital payments evolving, getting into more formalized segment. But yes, I think it is taking time. Still a long way to go. Still a long way to go.
So I want to ask you about the entrepreneurial challenges. Right? Financing is only one part of it, but when it comes to repayments, for example, it has a ton of risks, some of which you were sharing with us or whatever. Right? So financiers don't seem to get that. they're very straightforward that I can make a loan either structurally, the way the products are organized or the way they're delivered, etc. You want to throw a little bit of light on that and what could be some innovative, so I want to go to the innovative aspect. What are the innovative ways of thinking of fixing some of that?
Sure. So I'll just give a short brief. So I run Platform Asia, which is my flagship brand. It mainly involves food, energy, and water systems. We are present in about 12 countries now and about 1,200 people strong. It's a bootstrap enterprise. We do not take money from anyone simply because then no one can direct us to do what they want us to do. So it's designed in that fashion by choice. We have had a great run primarily because we focus mainly on intervention impact. So when I mean intervention impact means we look at a problem and we get hands into the problem. We don't just lend money or we don't just give money to people who need money. To give you some perspective of how we've tackled this, India actually has 126 million people who earn less than 20,000 rupees per annum. That is the actual number. To solve for the income impact, it is not about converting 20,000 rupees into doubling the income to 40,000 or 60,000. It's not going to take them anywhere. The real impact happens if you can actually increase the income by at least 20 to 25 times, which brings them to a 2 lakh or a 3 lakh sort of a segment. This part of the population is predominantly present from Aurangabad, if you take as a benchmark, and you extrapolate that in a triangle towards Varanasi and you take a triangle towards Chennai. That is the part of India which has this low income segment. Very few Indian businesses also go in that area. Most of them are on this side, which is the south and the west, up north. We, for whatever reasons, are in that part of India which is not very well banked or very well, industrialized to that extent. This is predominantly tribal and agricultural India, and we've gone ahead to build plants in all those states that are in that area. And my learning very clearly in that is that all of them actually are great repayment masters, to answer your question very clearly. The problem that they have is when and they're all smallholder title loans. So the problem that they actually have is they borrow money to grow whatever they are growing. And at that point, they are therefore at the mercy of whoever the trader is in between when the crop comes due. And I'll give you an example of how the banks look at it. And this is a classic example. Banks in India are designed to give money based on a 90-day or a 120-day credit cycle. There are certain crops where the cycle itself is 12 months. So you've got a mismatch right at the start. So there's no point giving the guy a 90-day or a 120-day loan when his crop itself is 12 months or 14 months. So there is a product level mismatch. And then you have a lack of post-harvest facilities, which creates another mismatch. So dragging in the MSME, because the MSME is a critical part in those areas, those MSMEs who have actually focused on creating infrastructure to help these businesses actually have a good money-making model that can arise out of it. Because at the end of the day, when you are allocating capital, your capital must create a return. Otherwise, that capital is actually losing out from an inflationary point of view. Eventually, you're losing out on capital. So, what we've done is in most of these areas, we have basically said whatever is the declared MSME rate, MSP rate for the agricultural produce that we collect, we will pay 20% more than that. We're very clear about how we operate. The second most important point that is there is most of these farmers do not get payment on time. That is where they actually suffer, and that is to answer the lady's question earlier, that can there be consumer products for them? The answer is actually yes. They're not poor. They're just at that wrong end of the curve when they don't have any recourse to go and demand payment because they are at the mercy of whoever is buying from them. That is the critical challenge in that undeserved community that needs to get resolved. And that is what I mean by intervention and impact using intervention. So we are very clear, we use our capital, we pay on time. It's now reached a point where in the recent floods that have taken place in Telangana, Andhra and many areas, I did not lose a single day of production. Simply because I have built that relationship now where they know that they have the product, they must get it there. And where they get it is a very important point. All of them do not have any transport. So if there is a finance industry or there is someone in the financial side who can actually sponsor the vehicles, we need to create that infrastructure to do that aggregation. So once you've done that aggregation, you actually solved the cost point. To answer your question, the aggregator typically takes 10 to 15 rupees on any product on a ton basis. If you solve for that, there is absolute clarity that you can easily pay 20% more than MSP. So that's how you intervene. Now, the government at some points has lost the plot in most of these places because there are no financial institutions looking at them at it. The only thing that they are happy to do is give them a motorcycle loan, give them all these loans which are consumer driven. You have to see how you're going to increase his income. And it is that income creation that will ultimately create, and what Arpita said as well, they are all hardworking people. You just need to create that income pattern for them, and you will see even urban to rural migration backwards, which we have actually observed in Koraput district. It has actually happened. So those are my thoughts.
Okay, thank you. I think and I'm certainly going to come back to you on the. Can we get the volume up a little? Yeah, I think so. It's about this very important point about income and liquidity. I think some part of the question that she asked. Often I think the poor or the underserved, they're getting busted because they don't have access to liquidity. It's not as much income. Right? If you see the larger companies, they fundamentally are far more liquid. Most firms go out of business not because they have loss of profitability, but they first go insolvent. Right? So I think there's no focus on the vulnerable from an insolvency standpoint. The liquidity aspect is always missed out. Right? And Munir and I briefly spoke about how this idea about returning, right, versus let's say working capital for larger firms, which are perpetual in nature, just structured as 1-year loans, right? But they're practically perpetual, right? I've rarely heard some consortium got together and said, okay, no, nothing more, right? Just automatically, in the good old days of APBF or whatever, 20% increase. There's perpetual financing available for those that have a lot, but for our consumers that perhaps need more, right? There's actually lesser. The structures are still not as suitable as they could be. Which I of course want you to take a slightly different lens on this and tell us a little bit about the work that you're doing. I'd like you to speak a little bit about the gender aspect as well. You also briefly shared something with me about how you build appropriate incentive structures when you are not the operator. So clearly there are two operators here, there are two investors, but I'd like to speak about your work.
Long time. Of course, I think I'll stitch it in with how you said, how do you define financial inclusion, and then tell you how we created structures internally. So I think financial inclusion, in my opinion, is used very loosely. I don't know how you feel, but sometimes used for the purpose of branding as well, because they say, oh yeah, we are financially inclusive. What does it mean? I'd love to ask that question to everybody in the room as well, because you're here listening to us. So I'll tell you clear cut how we define it. Firstly, there are 3 sectors that we invest in as a fund, that is healthcare, financial services and climate, that we feel are high impact sectors in terms of the services that they can deliver. Now, financial services, you'll ask me, is also really broad. So, how do you define that? Now, within financial services, we look at various subsectors. So, we look at fintech, we look at logistics, we look at healthcare, we look at education. We also look at e-commerce as a part of this. When defining financial inclusion, it's an impact theme for us outside of the sector. So we also wear an impact hat as a fund, where we have certain themes that have been created that entrepreneurs have to abide by. So the first theme is gender, to answer your question, and along with how startups have to do MIS reporting, right? How they have to report financials to you, they actually have to report impact metrics to us as well as a fund, which are set alongside them. So it's not vague or generic that here are 5 elements and let's create a report and let's publish it online. It's not like that. For every company, there is a framework that is created from these 3 sectors, and then they have to track that and report back to us. So in these themes for impact frameworks, they look at gender, they look at last mile access and livelihoods, and then the third theme is also climate. Within gender, it would be improving the gender balance internally or externally. It could also be within the team, how you are looking at the management. It could be the beneficiaries that you're impacting. It could also be employment generated for women. And then livelihoods and last mile access is getting product services delivered to areas where it is difficult to deliver. So that's something we try to capture in terms of investments. How do we, that sounds really interesting and nice, but how do you really do it? How do you enforce people to look at something like this? We also get financial incentives, which ties in with financial inclusion to be able to do this. So I think our fund leads by example. We're a solo female GP fund ourselves, which automatically attracts a lot of women entrepreneurs because they feel that, okay, we will understand their journey, we will invest in them. 100% of our Indian team is all female, 60% of our leadership is female. 60% plus of the capital that we have deployed in India and in Africa is for female-founded companies, and 50% of our companies in terms of numbers are also female CEOs over here. Now again, those are metrics, but where I'm going with this is that when you create an environment at the fund that you understand the journeys and you're able to encourage them to do better financially as well as from an impact perspective, you are able to get the necessary talent. And innovative structure that we've set up is the equitable venture pool. We offer profits from our fund to our founders, which means the upside of our fund is shared with them as well, which encourages them to do better collectively and not just individually, because if we make money, they also make money because the share of it is shared with them. And a part of that is the gender bonus. So we offer this structure when they unlock certain business milestones which are important for the business model that they are following, but also when they unlock gender milestones as part of the impact framework. And 2 of our Indian companies have actually unlocked that, and they are very much like our investors or partners in the fund, which encourages them to quickly use.
Wow. I just hope other VCs are not listening to this. Reading away to their carry. This is super impressive, I must say. I think it's very counterintuitive in the minute we've gone after. But most importantly, this has answered a question that everybody asks. Where are women founders? I know that they're all going to them. That's why nobody else gets it. Very impressive. I think it reflects intentionality in action. Because the number of times we get to hear about women founders, whatever, we want to be there. So, okay, what I'm going to do is, I'm going to now go back and I want to ask everybody to say one thing that others in their ecosystem should be doing. But that's going to be boring. So all of them have to say one thing controversial about the sector that they operate in. Actually, it's all this ecosystem, because the gossipy stuff. But before that, are there any questions or thoughts? Because I know we don't have that much time. I'd like to make sure that we can get. If there's anybody else, please.
And Pooja, you really touched the question. So let me give you an example to sort of demonstrate what kind of challenge that is. Because when you said liquidity is not being addressed, I thought that was fundamental and it came out of that discussion. And liquidity has a factor of two things. One, the time, and second is ease. So, let's say that, there's a woman whose husband actually runs the cab. That particular day he falls sick. And she said, look, I can take the cab, but I wish I just had 500 bucks to put out the petrol so that the next ride will give me 1,000 bucks and I can repay this immediately. So it's not a structured, she's not in the structured pool of people who can access funds. So it's unstructured. The timing is very essential because you don't know when her husband is going to fall sick, but she can earn 500 bucks just sitting because of that particular thing. And the third element is the ease. I mean, she's not going to run around that morning to get that 500 bucks. So, and she says that, look, I'm using GPay and I'm using all UPI, so you have details of my transactions, I've never defaulted, I have everything in the world. But yet there is no product for me to be able to service this particular need. So it's a livelihood thing, it's unstructured. She may need it just today, tomorrow she may not need it also, she may not need it for the next 1 month. Are we as an industry looking at those kind of stuff? Because those are, I mean, to my mind, are the most underserved.
I mean, if I can just take that, I'll say the short answer is no. The long answer is certainly not, right? And all of this, every single thing that you asked for, is available to everybody in this. I have access to credit that I don't need. Instant. I have some X number of cards, they're useless. It comes to me, I can straight away go and not even use that limit and spread over or whatever. I think this is I'm going to be controversial. We're going to get started with that. I think clearly it's a failure of marketing. Right? I mean, I think we're just super excited about some success that we've had with microcredit outreach, for example, or whatever. Have we done much thereafter? What do we have to show for last 7 years? Say something like this, for example. You still got that same 50 to whatever it's we're doing more and more or whatever. You're spot on. And I think, I was reading something about the fact that in Karnataka or Bangalore, they gave free bus rides to women. And what they started doing is that women started going out because for families, the kind not you spoke about, but in the urban setting similar, the bus fare itself makes a difference. Right? So now, if the husband went, he would have to pay, but the wife, and therefore women participation started to grow. We don't have enough data for somebody to be able to come to the table and say, they did RCT or this, that. They haven't done that. But I've seen intuitively it seemed to make sense. Right? So yeah, I think clearly failure there, but I hope somebody will prove me wrong. Anybody else? Is there any question, anything in particular you want to hear from them before I ask them to tell us something controversial?
So I have two questions. One is to Pooja, with respect to the data that you are tracking with your SMEs to report on the 3 aspects you mentioned. How convenient or easy is it for them to report this data, and what are the challenges you are facing on that? And the other question is open to the panel, like as lenders yourself, what is the kind of support you require? Because we are, as you were mentioning about the new kinds of products that are required, and considering that say the yield cycle is longer and you need to innovate that way, what is the support that you require as lenders from say a DFI or any other investment firm?
No, thank you for the question. I think it's a very relevant question that you want to track impact. Is it even easy for the company to track it, or are they tracking it because you're investing in them and thus they have to? And I think the secret sauce is that you have to find the right founders. It's the secret sauce. When I say we look at gender, it's not like we will go and fund every company that is founded by a female. We also have companies that are completely male founded. And then we encourage them to think about metrics that they perhaps have not thought about. So that's the change that you're trying to make, that maybe it does not occur to them. Can you bring about that change? But specifically, when you invest in a certain set of conscious founders, right, you discuss with them what is it that you're already tracking. Do you know it falls into these certain levers, and is it possible to achieve the same? So we have a process, we have an impact team internally where after an investment we feel is going to go through, we discuss with the founder that list out everything that you are tracking so that we're not reinventing the wheel. And let's together structure this with certain milestones, certain outputs, certain outcomes, and then certain impact levers, and then timelines attached to it and goals attached to it that you perhaps are already doing but are not tracking. You're already unlocking that impact, but you're not tracking it. So can you track it? And if they're willing to do so, That's why we invest, because that's a change we want to do.
So there was another question for lenders. So we don't have lenders, but maybe Arpita and Anirudh, you can speak on the individual side, and then Puneet can address it on that.
Can you just repeat the question for the lenders?
Yeah, so I was asking, what is the support that you require, like as an MFI or as a NBFC? What is the kind of support you require in building these products or these innovative products, customized products really for the market?
So I'm not a lender, I'm an investor in MFIs. But typically the MFIs, I believe, start with customer research. They look at their own data. So I can just give you an example. Like we work with our partners and we encourage them, and we also contribute to the cost of doing the employee engagement surveys, right? 60 dBs, 60 decibels is an organization which is doing it. And when they come out with the results of the user engagement surveys, there are some findings there, right? So, if there's a question which says the kids were not able to go to school less than before, or the fees was not paid, then we engage with the partners and encourage them to find out reasons and then do research around it. We also sometimes through our edu finance actually help them do that research and develop a product which is more customized to what they are hearing from their clients. So that kind of works.
Yeah, so just speaking my heart out, need to be more hardworking in terms of underwriting. The JLG has to move to an individual model. The product design has to include what's actually happening on the ground. And it was talked about that the loan tenures are so rigid, right? All of us are finance professionals, and we know that if your incomes are not coming in monthly, how can you pay a loan on monthly basis? But then to design a loan which is flexible, not enough people are doing it. I mean, we are fully capable of doing it, but we're not doing it. So that's why I'm saying that let's upgrade our underwriting, let's move to individual loans, and in that sense, let's be more hardworking.
So basically, if I talk about from a lender standpoint, okay, and I talk more about the liability side. Okay. Obviously, for lend, you need to raise debt or equity. So for lender, the immediate support that we need is capital, debt, be it equity or debt, but that at a competitive pricing, at a cheaper price. If I'm able to raise my capital at a very lower price, obviously the onward lending will also be at a lower price. And in the start, when I spoke about the credit gap that exists in the market, particularly underserved segment, it is 45 lakh crore. It is a huge credit gap that exists. If I want to address that gap, I should be able to raise capital at a very, very competitive or low pricing. I think that's an immediate support. Coming back to your point in terms of that innovation, the point that you made, like fintechs now, upcoming fintechs or new age lenders like us, we are not only, I would say, fixed towards a one repayment model. We come up with tailor-made solutions for MSME customer wherein the flexibility in the repayment option is given. It need not be necessarily monthly, it can be daily, weekly, fortnightly, which again suits your cash flow. Okay. So I think it is all depends upon that.
I'll just add a few lines from a very pragmatic approach of what we do. So there's a lot of times where the farmer actually fails in his crops as well. So it's not like every time he will successfully get the yield or whatever. So actually, if you go back in history, in agrarian India, there used to be a concept called Anabari system, and what it basically did was that he failed his crop. We again fund him for his next crop, but we then extrapolate the loss over the crops that he supplies in the next round. So these type of product innovations were there. It's just that over the years with regulatory requirements or compliance with BIS or whatever different banks have to follow, we've actually digressed away from solutions which were there. So whichever lender, whichever financial institution or MFI or DFI at that level can actually push these type of innovative solutions for the agrarian economy. And I am very focused on that because primarily that is in short half the world. So therefore if you solve for that population, it does not matter whether you solve it in India or whether you solve it in Indonesia, the problems are exactly the same in all the 12 countries we operate. So it's just that the currency changes. The perspective of creating those innovative financial products needs to come from ourselves. No government is going to do it because they have far too many regulations, and by the time the solution comes, the farmer is already dead. So if you really want to do it, you intervene, you solve for it, and in our case, we have created a closed loop system. So we fund, we buy, but we are transparent to him in what we buy, so we give him that 20% markup. It's very clear. Now, there are farmers who will come and say, I want a higher markup. I say no, because I have to also build my reserve on the side. Now, I am a single corporate only, but there are so many financial institutions, there are much more esteemed people. If they actually come together, you can actually build that, can convert that 126 million population, and you can actually bring them to a point where their income actually goes up by 15 or 20x. That is when you would have created an impact on the bottom of the pyramid. Making 20,000 rupees into 40,000 rupees is not going to solve anyone's life. Neither will it solve for rural to urban migration, which is a major problem in today's context, because most of the farmers are very happy, or like what Anirudh said, while we have to do the hard work, even a farmer has to do hard work. But he has now got this option of becoming a driver or a casual laborer in another city for 6 months, and then he comes to tend his field for 6 months. So if you solve for their income level at the farm gate and you solve for it correctly, you automatically even solve for food security. If you look at it from a very macro perspective, and that's why I said, and since Shashank said that you should say something controversial, you can actually go ahead and solve for your own nation's needs, provided you actually solve for what is needed from an income point of view, which is their livelihood. If you solve for livelihood, automatically their need for a consumer, the ability to pay for a consumer loan also comes through. So you're actually inverting the pyramid as you go along. I'll put it at that.
I want to challenge that that's not controversial enough. But you have a question, sir.
Yeah, actually I wanted to talk about something that Prabhav just mentioned. But on the flip side, he was talking about the guy who actually goes to the urban economy for the 6 months, works over there. Even there, for example, if he's working in the last mile sector where we work as an EV company, that guy, 92% of the last mile guys are actually individual owners. But those individual owners who want to go to electric vehicles can't get, forget 90%, 20% IRRs. They are not getting loans. They're not getting loans. They're paying swapping services from urban players because that way that increases their services. They're paying GST 18%. So the lowest pyramid, or the lowest part of the broadest that pyramid is actually not just not getting loans, but is actually paying higher than what normal people are paying for normal services from a taxation perspective from the government itself. So how do, and the only thing which comes to our mind as a finance guy and worked in banking is something from a microfinance perspective, what we did for villages where women were given loans on terms of community lending, right? That okay, ठीक है, वापस चला जाता है, पैसे नहीं देगा, लेकिन 4 लोगों के साथ में काम करेगा तो वापस आके उसको ये होगा कि मैं इन ग्रुप के लिए तो पैसे दे दूँ. Those kind of products have to, I don't know if any of the ESG panel members or any of those entrepreneurs are working on that, but that will help the electrification. That will help these guys also earn more. That will help, as Pradipto pointed out, them earning more also from other jobs. So I don't know if that is being looked at as a solution.
Sure. Yes, sir.
Yeah. The mic. Well, anyway, this room, I think you all can hear me. Yeah, I think when we are talking about innovative financial products, maybe there is one product which is very popular. People use it a lot, but we are not talking about it. That is the guarantee product. Today, only one lender of foreign bank was talking to me. And he said that all these impact sectors that we are talking about, in microfinance, so many institutions who provided guarantees, especially the DFI. So we are talking about solar or any other product, or even in microfinance, if you are talking of a longer tenure of 36 months. If DFI or some other can provide guarantee, and once there is a proof of concept, that is a very good way to scale it up.
Yeah, I mean, just to add to that, there has been next to no innovation in non-funded forms of financing for at least 50 years. At least 50 years. We're still living with the same guarantees, same SBLC, same letter of credit or whatever. Next to no movement at all. But I have a challenge, and simply because Anirudh brought it upon himself. Is it true, Arpita and Anirudh, that the MSME financiers or those which are extremely unique like Pradeep, who don't need anybody else's money, are able to go out and do innovative stuff? Versus, I know you will say you're not the MFI, but I know that you're influencing, like in a very nice way. And you're actually shaping the product, services, you deal a lot with client protection and all of that. So do you think that it hasn't kept pace, the other sectors have gone on further in terms of innovation versus people from low and middle income communities that MFIs have gone to serve?
No, I think we realized that problem very late in the industry, and again, I'm going to go back to microfinance because we continue to follow a 35-40-year-old microfinance model. Had we changed JLG to an individual loan, let's say 15 years ago, transitioning to innovative MSME lending would have been much easier. So I think the journey has been great, but NeoGrowth is doing fantastic work when it comes to creating solutions for MSME lending. And I think startups have done a good job so far. It's still early days, but I think we are going the right way. There is the tech systems which used to be archaic with banks, they couldn't have multiple products, but fintechs, and I'm sure even NeoGrowth has multiple products because their tech systems can support it. So multiple products are there, product customizations are there, underwriting parameters have become much more comprehensive. It is now possible to underwrite everybody. Previously, there was no visibility about cash, but now with digital collections, even cash visibility is there. So I think we are heading the right way.
So my challenge was that when MSMEs and lenders to them, etc., are able to, business to business is able to do such sort of innovation, why is it not available to those that are vulnerable or underserved deeply? Right? Why is it that MFIs are, that's the challenging, controversial view, that why is that innovation taking so long? All of this is applicable even for individuals. We are certainly have better data. Now we have so many years of credit bureau, we have such incredible regulation. Seemingly all the building blocks are there, but or is it possible that we are not seeing but some innovation is happening on the ground? Here,
So if I take, since we're talking about microfinance as being the beginner of reaching out to this customer segment which didn't have access to data credit. See, the microfinance model is based on the fact that the loan officer just needs to collect a group of women and give them loan who know each other and they're social collateral for each other. That has been, though that has also helped the sector reach where is it, 70 billion and 4.5 lakh crores and whatever else we may say. But it's also been the problem because the entire industry, you have this field force which does not understand how credit underwriting is done. So I think that has become a problem which is pulling us back. But having said that, there is innovation happening. Our digital stack, our UPI footprint, which even the nano and small enterprises have now, is getting leverage to create a map or the credit map of an individual micro and small. I'm not even talking medium enterprises, like micro, because if semi-urban or urban, you definitely have a UPI footprint, right? So I think that is there. The innovation should also come in terms of the not only how you're creating a credit map for them, but also in terms of timing. So it's very important, the point that Smita was raising. And I think it's not that there's no product, fintechs are there. How good they are and how responsibly they are lending is a matter for maybe another session. But they are there who are giving loans at the drop of a hat. But I think the turnaround time is very important. I hear all the time, as you would be knowing, that he he says, I'm okay to give you, they don't calculate the interest. They're saying, हर 1,000 रुपए पे मुझे कितने इतना ही देना पड़ेगा, but अगर आज मिल जाए loan, they are willing to give it, right? So I think it's also, the innovation also has to come in the turnaround, besides, the amount and all of that. So there's a lot of scope, but we are in the right direction, and our guardrails of digital in India is really helping that.
Okay, we're at 5. Yes, sir.
Good evening, Abhishek Fogler here. I just wanted to know from the panel their views around collections as a service. Right now the problem is not lending, it's really recovery in most places because the fintechs have lent helter-skelter and now there's nobody, no feet on the street to collect the loans. So in my opinion, collections as a service is probably a multi-billion-dollar opportunity in India, which there's not too much of focus towards. Yes, you have people like DPD90 and other, that those are more SaaS tools. There are no real feet on street on the ground who are doing it, apart from the normal run-of-the-mill collection agencies. So I'd like to know the views of the panel on the collection as a service model. Thank you.
Maybe you want to take that first because you can do the business part and then.
I think it depends on a. I think it depends on a player-to-player, okay, what sort of robust collection framework that you have. Okay, I have seen fintechs where the moment account crosses 30 DPD, it goes on to some agency, and there and again they start using the muscle power again, and the reputational risk comes into picture. But fintechs or new age lenders like us, we have everything in-house. Okay, because in-house, see, nowadays collection is no matter what the story of you use the muscle power or you increase the fill intensity. It is more about connecting with the customer, engaging with the customer, understanding what went wrong, providing him a solution, and then only you can get the money back. Just to add on it, the kind of innovative tools that we use, like in our scheme of things, the repayment option is 100% daily. So if I compare myself or new growth customer with any other lender, I am 1 month ahead of market. Because the moment the customer misses his repayment of 3 or 4 DPD, 4 or days, I get to know that there is some problem. So I'm able to send my guy across, understand what is the issue and all that. Unlike market, wherein he will get to know after a month. So I think again it's a combination of your product innovation wherein the collection practices play an important role.
Abhishek won't like my answer, but I prefer, as you rightly mentioned, there's a reputation risk attached to it because collections has to be done responsibly. And that's why as an investor I prefer our investing company to be doing it themselves, not outsourcing it.
I would say that too, because the moment you have third-party collection services, their only metric would be how much they collect, right? And not how they collect. So as an impact investor, I would be very worried if my investee says that don't worry about it, we have collection services to collect. So I would really discourage it, and I would rather go with this approach where you understand it. And we've seen instances of investees during COVID time, the ones who were constantly engaged with the customer to the point that he's making, they were able to even collect during COVID. Because you have to know your customer. The moment you outsource it to a third party, there's that one metric which could really make it a reputation risk.
Yeah, AP crisis is long ago.
Yeah.
But even then, the MFIs, if you saw after the crisis blew over,
Yeah.
the recovery rates were very different for different firms depending on what level of engagement, whether they then used agents to form groups, whatever. Yeah.
I'll have to agree with them, but I'll tell you why. I'm sure it's a good business model and there's a demand for it as entrepreneurs and they feel it's white space. But as investors, like I said, I think it's about trust. So you would want an end-to-end model, especially if you're talking about the underserved segment, right? So you would want to know your target audience and cater to them completely end-to-end. And that's what we will build the trust on. But in the long run, how will it work?
Okay, so controversial stuff starting from Anirudh, and then we go on to more.
So let me talk about climate adaptation. And I've been articulating about it more and more also internally. And so what I want to really trigger is why is DFI money now going into climate as a sector and not into financial inclusion, right? And it's a very classical European US thinking that let's solve for the climate emission. But what about the poor people who are not responsible for climate emissions? For them, adaptation matters more. And I think exactly what all of us have discussed before in things like flexible repayment, longer tenure loans, insurances. So why aren't the DFIs from a climate lens looking into those solutions today? Yeah, that's something I really feel for. Shashank.
Going to go after DFIs or somebody else?
No,
I'm just going to, one point that I mentioned earlier is often I wonder whether, like I said, a fifth cycle client, have we left her better off or not? I wonder, I still haven't got answers. I've talked to a lot of microfinance experts. I'm not one of them, but I've asked them. I haven't got an answer to that. That is something that is out there. The other one that I often wonder is that, and that's whether it's controversial or not, but the entire world believes that microfinance helps the women, addresses their gap. But look at the taxes that are levied. Look at the end interest rate that are getting charged. And I'm not blaming the MFIs because they get it at that price and they have to add their operating costs and put it out. So why as an ecosystem we are not getting it down? If I can get a loan at a 7%, 8%, whatever number, I haven't tried to get a loan for some time now, then why is a lady who is like pretty much on the road gets it at 26%? It's not fair. So somewhere the system is wrong here. And so in some way I feel everybody is paying lip service to this, but not really looking at it. So that's my bit.
Mine would be slightly political also.
Open to bar some money.
On a serious note, I think the kind of segment that fintechs or even lenders operate in, which is, as I said, is more underserved and underserved segment. But sir, that's a different risk environment that we operate in. Okay, so your loss rate, your credit losses are bound to be on a higher side. Okay? But the Indian, financial ecosystem, the lens to look at our fintechs is completely different the way they look at the PSUs, and perhaps that is the reason our cost of borrowing is always been on a higher side. I think somewhere down the line that needs to be acknowledged that the kind of financial inclusion that people are driving by operating in this segment, loss rate is bound to be high. I think somewhere down the line that cost of borrowing needs to come down. The lens needs to be same. That's all.
So I will give a very different perspective from the point of view that taking into account what both Anirudh and Arpita also said, and to some extent Manvi, you see the flow that we see has been always that the farmer in the global south, and I'm now saying the global south from a very clear perspective, has always been at the receiving end because we have to prepare something to feed the wealthier nations. That is the trade flow. Now for some strange reason after COVID, and whether people like Mr. Putin or don't like Mr. Putin, the flow has changed. And that flow has actually now gone diametrically opposite. And I'll give you a classic example. Pre-COVID, I used to sell to Walmart. Post-COVID, I don't sell to Walmart. Simple difference is, Walmart wants me to supply at a price which I don't need because I get 2 times the price selling it outside my factory at Srikakulam. I don't need Walmart anymore as a client. So the flow of the trade has changed. People are more interested in buying good products even in the global south. So, and that is the shift that agri or the commodity based industry, or when I say commodity I mean value added commodity. I'm not just saying that you just make a commodity product and you ship it out. Because traditionally that is the game. Now you study where Africa, the reason why cocoa prices have gone up is exactly the same. We will all buy French chocolates, Swiss chocolates, but not a single country actually even has a cocoa plantation. So the the whole game has always been to take. So when colonialism left, and I'm just going back as a student of history slightly back, it just got shifted into a modern version of imperialism. And that entire trade flow has actually got appended. How it has got appended is anybody's wild guess, but it has. And you, as a manufacturer and as a producer in 12 countries, we can actually see that shift. So unless you are solving for that at a localized level, and you are still running a business where you're still thinking that I will produce and I will sell to the US market, or I will sell to a larger consumer market like Europe or US, you will soon realize in a year's time or 2 years from now that those markets actually will not exist. Because fundamentally, and to borrow this from what is coming in the news in the last 1 week, fundamentally America has actually gone bankrupt. That is the reality. The problem is no one is willing to acknowledge the reality. And I leave the audience with and the panel with an analogy of it. It's like going to Ocean Park or Sea Aquarium to visit. Depending on where you are seated and how you are clothed, you will get wet when the collapse will happen. It's the choice of what you're wearing and where you're sitting. So that is the event that is going to happen, irrespective in the market. And that's what countries, people, financial institutions actually have to anticipate and set the pace for their own requirements. That's as controversial as I do.
Still nicer than what happens when the tide goes away, but we'll leave that aside.
Thanks. I think a few of you spoke about interest rates, cost of borrowings, but for certain audiences that you do feel strongly about, so I'll just touch upon that maybe with entrepreneurs, because it's a similar problem, and I don't know the solution because I'm sure many of you have witnessed this as well. When a company is doing well, it is obvious that they can get lower interest rates in terms of debt. It is when a company is not doing well that it requires lower interest rates so that they can prove themselves and go forward. Now, I don't mean that okay, everybody should just wear this crown of impact and just give those lower interest rates without thinking through the business. But how can you innovatively think about this? I think as entrepreneurs, many times they're in situations where there is a low. It's a low and it's an up, it's a low. It's never constantly an up and down, right? And they will find themselves in a situation where there's a cash crunch and they're unable to find liquidity. Because people are saying, okay, reach a certain level and then we will pump money in you, and it becomes a chicken and egg situation. It's a catch-22. And then even debt providers will say, yes, sorry, it does not meet the guidelines, so what do you do? We were contemplating this, a lot of our entrepreneurs actually came back and said this to us, that we are looking for, we don't have flexible terms, we don't have interest rates that we do. And the turnaround time is not as fast as we want them to be, because these are not entities that believe in us or have known our journey, so how do you fix that? So last year we set up a debt fund for that. It wasn't in our plans, but so that we can lend only to our entrepreneurs who have belief in them, and even if the terms at that point in time are below market interest rate, it's really quick and it's flexible. It's a way of sort of supporting them, because the same problem, right? At that point, nobody will lend.
I'll just quickly summarize what Pooja said. I mean, you're horrible people. Never stand by people in the time. That's what you meant, right? Trying to make sense of this.
He's trying to make my statement controversial and very targeted, and that's absolutely not what I meant.
Meanwhile, I've got a message from Divya here saying that I will never be allowed in any IIC event after what's happened right now. It has been such a pleasure. Thank you so much for your time. We could go on for a long time, but I really appreciate all your insights. Thank you for being here.